Meet Jim and Jane. Both would like to go to their local lender and get some money to run their prospective businesses. Jim already has a lemonade stand, and Jane would like to start a lemonade stand. They both want to ask the question,
what do I need to do
to become bankable?
What we're looking for is to see how profitable a company is. We're also looking at their annual revenues to see whether or not they're trending up or down. We also are looking to see if the business has the capacity to service any additional debt.
Jim would like to obtain a loan for both working capital and to make an equipment purchase. And since he already owns his own small business, he'll simply need to go to the lender and be able to show...
You accidentally locked the door.
He'll simply need to go to the lender and show them his existing financial statements.
It's very cold out.
And those financial statements will be able to show how financially viable his business truly is.
I don't have an overcoat.
Income statement. Has the revenue been growing, or is it at least steady? Are profits increasing as a percentage of your sales? Balance sheet. Are all of your assets just old accounts receivable? Do you actually have some equity? Cash flow statement. Do you have enough working capital or cash at the end of each period to stay in business? Now let's take a look at more in-depth ratios that lenders find important. Key financial ratios. A lender will take a look at your numbers in your financial statements and determine how bankable you are. Lenders will also compare key financial ratios in your business to other businesses in your industry so they can get an apples-to-apples comparison. Harmon can catch. Let's take a look at a few of the ratios lenders will use. Debt to worth ratio. Your liabilities divided by your equity. Lenders usually like to see this as no more than a 4-to-1 ratio, or in this case, 20,000 divided by 5,000 gives you 4. This shows that you're not all debt and no ownership. This also shows that you have the ability to repay on a debt. Current ratio. These are your current assets, things like cash, accounts receivable, or just anything that can be turned into cash in less than a year, divided by your current liabilities, or in this case, your accounts payable. This has to be at least a 1-to-1 ratio, and lenders usually like to see a 2-to-1 ratio. So in this case, $10,000 of current assets divided by $5,000 of current liabilities gives you a 2-to-1 ratio. This shows that the lemonade stand can pay its immediate debt with no major issues. Debt service coverage ratio. This is your net income divided by the total debt service, and debt service is just the amount of money you pay out for a debt over a given period of time. Lenders usually like to see this as no more than a 1.25-to-1 ratio, or in this case, $20,000 divided by $16,000 gives you a 1.25-to-1 ratio. Also, the bank will be very interested to see how quickly you can collect on your accounts receivable, that's money people owe you for products or services, and how quickly you sell your inventory. The lender will ask Jim for a month-to-month cash flow projection based on his existing cash flow statement and showing his new debt service and additional revenues he hopes to get. Lastly, the lender may even ask Jim for a brief business plan explaining how this loan will assist him in his business.
You accidentally locked the door. It's very cold out.